To our April 20th webinar entitled Weathering, the Withering Rise in Interest Rates. If you're not feeling that rise, or your children aren't, you haven't been reading the newspapers. But regardless, we've got an excellent presenter today in Bob Ashe, who spent some time working for the federal government as an auditor and then came to Alberta. That's a story in itself. But Robert studied commerce and public administration at Carleton University and political science at the University of Alberta, where he received his PhD. He joined the Alberta Federal and Governmental Affairs in 1984, and then moved into Alberta Treasury in 86. He's a publisher. He's published several books. In 1989, Politics and Public Debt, which is a story in itself and one he might want to elaborate on today. And he also worked for ATB Financial from 96 to 2009. He's an editor and contributor to A Sales Tax to Alberta, Why and How, and his articles have appeared in numerous magazines, and you'll periodically see him quoted in the newspaper. He's also got a blog, abpolcon.ca. Today, and that's why I think several of you have joined us today and are viewing this video, you may be feeling the pinch, as many are, or the pain of being overexposed to the rise in interest rates, even though there appears to be some good news this week that they may be coming down. But the COVID hangover continues, and people aren't returning to the workplace, which is having significant impact on the rental environment in our downtown urban environments. And how bad is it, and will it get worse, or is the hangover now coming to an end? Well, this week's webinar will explore the realities of a very complex economy and the impact on you, whether you're an investor or pensioner, a homeowner, or just a shopper, or, now that I think of it, if you're a politician. So welcome to today's webinar. And Bob, I'm going to turn it over to you now.
Okay, well, thank you very much, Perry, and your esteemed colleagues today for giving me an opportunity to talk about the interest rate storm. And I would want to start with a little bit of a comedy, The Two Johns, and the story about the global financial crisis. Before I do that, I'll just have a couple of slides from the recent IMF report on financial stability. Because central banks are so critical in the formulation and the movement of interest rates, I talk about the role and tools of central banks, giving you a little bit of background on that. Also highlighting, most of my attention is going to be directed to the Federal Reserve Bank. And then I'll have a chart showing you some of the interest rates over the last 20 years or so, because I think it's very important to see that, you know, we go through time, and there, from moment to moment, there are connections, and there's reasons for those connections. And then really the meat of the story is, well, what are the effects on individual consumers, companies? And I haven't talked about governments, but in the preview, we did spend a little bit of time, and rising interest rates are very important to provincial and federal governments, state governments. So I'll look at the effects. I'll offer some sort of comments, general comments on the global economy, and then some preliminary conclusions. So the IMF central bankers from major the IMF countries, which are over 100, and the ministers of finance and deputy ministers met in Washington for their semi-annual meeting and made this statement about the recent events, which is the Silicon Valley Bank failure, are reminders of the challenges posed by the interaction between tighter monetary conditions and vulnerabilities built up since the global financial crisis. So then we're connecting back in time to decisions made in an emergency, which have significant consequences. And the other note that I picked up was that the financial sector assessment programs in various countries have flagged country-specific gaps in supervision, regulation, and resolution. And specifically, they're talking about the US, both the Fed and the Office of the Comptroller of the Currency, as well as the Swiss Banking Authority. So for a little bit of humor, okay, so I mean, basically the message from the two Johns is that the markets operate on a kind of a herd instinct and animal spirits. So that's one of the messages, that they're very reactive, it's emotional, it's not rational. The second part of it is a very clever discussion of the mortgage-backed securities problems that were set up. And essentially you had mortgage brokers that would go into areas where lower middle income people did not own their own houses, but the mortgage brokers sold the story that they could get a mortgage. Interest rates were very low at the time, and there were all kinds of special types of vehicles that came out called special investment vehicles, SIVs, which caused some laughter in the audience. And they were defined by or sold as high quality, and some were leveraged, which had good and bad things, but they were horrendously complex. And banks would be prepared to take these mortgages through the securitization process, which means that you as a borrower and you could have no income or very little income, and this was a big part of the problem. And so the banks were purely intermediaries here, and they were bought by individual investors, but also institutional investors. And this thing worked fine because there was a belief in the system that real estate prices could only go one way, and that it was up. So in the lead up to the crisis, you had this over exuberance. And if any of you watched the short TV program or movie, there's an example of this person that wanted to understand how this worked, and he went to Miami and figured this all out. And he interviewed a stripper that had 4 mortgages, so she was talked into this, and it was just corrupt, the bottom line. And so central banks were then placed that had, during the period after 2000 tech meltdown, reduced interest rates significantly and I've got a chart coming up showing that. And this led to this system of easy extension of credit. Interest rates were low, motivations to mortgage brokers to go out and sell and sell and sell package. There wasn't any risk to the bank. They underwrote it, and then they sold it on Wall Street. And that's how it became a real big problem, because some of the investment banks like Bear Stearns and Lehman Brothers, that was their core business. So central banks play a very important role, as we all know, in the modern economy. From the Bank of England's website, some of these points include secure banknotes. So this is becoming less important, but with the we're on the cusp of digital banknotes. But that's a big important process. Stable prices, that's usually one of the mandates, if not the preeminent mandate of central banks. Another function of central banks, and this varies from jurisdiction to jurisdiction, is supervision of banks. So you want sound banks and a resilient financial system, which means not just banks, but large insurance company, pension funds, and so on. And then there's the whole question about, and it's in the Bank of Canada's mandate, to ensure the productivity and the economic health and well-being of the country. So what are the tools? What are the means by which central banks achieve these goals that I mentioned? First of all, we'll talk about supervision. Well, supervision allows either central banks or supervisory authorities like OSFI in Canada to get information, to set guidelines and policies and restrictions on lending, to set up the whole regulatory system, which includes the apparatus under the Canada's Bank Act. And then there are subordinate institutions like credit unions, where federal government doesn't play a big role in credit unions. But the core of Canada's financial system is essentially, as you know, 6 national banks. One of the roles is lender of last resort. And what that means is that in theory, at least, if a bank gets into difficulty and it's a short-term liquidity crisis, that you look at their balance sheet, the auditors have come in and they say this is just a short-term problem, then they will lend on the security of collateral which is provided by the banks. And this is what happened in the Canadian Commercial Bank situation and Northlands Bank in Alberta in the 1980s. And there's some dispute after the fact about whether they were solvent or not, but that's a bit of a detail. Open market operations is the buying and selling of government securities to influence the price of those securities and hence the yield or the interest rate on that. And that's where they will buy and sell. If they're buying securities, it is loosening policy, lowering interest rates. If they're selling, they're hiking interest rates. Moral suasion is a kind of a quaint term for the governor of the central bank calling in commercial bankers and saying, we think you're being too lax lending on commercial real estate, for example. And so they try to, without advertising it to the market, having a quiet discussion to change credit policies, essentially. And then a more recent technique, of course, since the global financial crisis, is quantitative easing, or QE, or quantitative tightening, which we saw in the period really beginning in about 2016-17. The role of central banks, the second slide, is because we're really focusing on the central bank of central banks, which is the Federal Reserve, because the US dollar is paramount in both trade and in financial transactions. So it has a dual mandate, which is, again, promoting maximum employment, stable prices, and moderate long-term interest rates. And that means that there is a delicate balancing at every meeting they have to discuss what to do with the interest rate, is what impact is this going to have in employment, as well as the general economy. So that is one of the considerations that we see now as we lead up to the next Fed meeting. There's conversations, given the fragility of the financial system, will we stop raising interest rates because we're causing considerable amount of pain. Now here is a chart that starts in 97, and it's 1 month non-financial commercial paper. There are hundreds of other examples I could give, but this is essentially mirrors what we have with the federal overnight rate. And after the buildup in the NASDAQ, hopefully you can see the cursor there, going up to 2000, where we had the tech crash, and Greenspan was in charge, and that shook the economy, and whether or not that decision to cut interest rates substantially was wise or not. But you can see how dramatic the fall is to just below 2% and then to 1%. Well, what that did over that period leading up to the financial crisis was to encourage more risk-taking. You saw the excesses, as I described, in the mortgage-backed securities. But at some point, with the economy growing, particularly the housing sector overheating, the Fed got religion again, and up it went, and it very rapidly led to the financial crisis, which then in turn, down we went very quickly to basically zero, where it sat that way, for 5 or 6 years. The economy wasn't really coming back after the crisis, and unemployment rates were high, and that being part of the dual mandate meant that they would keep rates lower for longer. Now, then we started hearing quantitative tightening. When was the Fed going to reduce its trillions of dollars of securities and selling those? Well, by selling them, it tightened monetary conditions, and it meant that the economy and borrowers would have to adjust. Now, that process, you can see, went on until we had March 2020 in effect, which is the start of COVID, and then once again a major drop to zero. And now, with COVID over, central banks have decided to raise interest rates, and that's really where we are today. So what are some of the effects on consumers, businesses, and ultimately governments? And so what you have from the Fed is the debt service ratio for consumers. And as you would expect, it again, and this period of time is from 1980. So I'll really start the story back in 1997 or so. And you saw here at the peak in around 2000, and you saw the decline in interest rates during the early 2000s, again responding to the tech crisis. And then Greenspan decided before he left we needed to tighten, and so the debt service ratio went up. You had the aftermath of the global financial crisis, and interest rates dropped like a stone. So what that meant was that the surviving mortgage holders could refinance their loans at very low rates of interest, which they did. There's penalties attached to that, but This is the result of low interest rates. And then, of course, you had a period of rising interest rates, and then COVID, and then once again, you had another, we've seen this rising period. So it's back up to about 10%. It's below what we saw the rates before the financial crisis right there. But there's obviously quite a bit of stress in the financial system, and naturally a lot of financial stress on families that do have floating rate debt, which includes, of course, credit cards, car loans, and so forth. So the commercial paper rates, again, these are similar to what we've seen in the commercial paper on the other chart, and these are overnight rates. But once again, movements of interest rates, particularly down, are very sharp, and that shows, I think, the alacrity of central banks in responding to perceptions that the financial system, the banking system, through which all the plumbing and modern economies flow, would be plugged up and jammed. And so liquidity is just that mechanism to get things unstuck. You have certain markets in the global financial crisis that banks would not lend to banks, or were fearful to lend overnight. Once you get into those conditions, it's very worrisome.
Bob, let me interrupt just for a second. Something that just came to mind, because in each of these charts, the one thing that stands out is how sharp the rises and the falls are. There's a psychology that says people don't pay much attention, and maybe the banks are included, if things happen gradually. So if I'm heading the banking industry, it would seem to me that shocking the market is almost intentional. Waiting and waiting and waiting, and then making a steep adjustment catches everybody's attention. Whereas if this were to occur gradually, they might just go on for quite some time and absorb all this to an even more detrimental effect. Do you want to talk at all about the relevance of shocking the market in order to get attention?
Yeah, no, very, very good question, Perry. I mean, students of central banking, the people that work in Wall Street, the people that work at incl and so on, that are interest rate strategists, the Federal Reserve and the Bank of Canada, they try as best they can to signal the pace of monetary adjustments based on what their imperfect knowledge is on economic conditions, and what they see perhaps are certain bottlenecks in the economy, but in particular the consumer price index. And so their central bankers are human. What we saw in the most recent uptick was, I think, a fundamental misreading of inflation signals. And you would hear central bankers talk about, oh, this is transitory, this is due to COVID, blah, blah, blah. And it did not prove to be transitory. Now, to be sure, Ukraine happened, and that created another dynamic. But the central bankers spend a lot of time looking at financial market information, futures market, and they, when they make announcements, they do not want the market to be, they don't want to be spooked. Now, in terms of the financial crisis in 2007 and 8, I was at ATB at the time, and it was a little bit of a slow train wreck. because in 2007, we had our ABCP crisis in Canada, and there was fear that it would spread to Deutsche Bank, which was big in this market. And then you had Bear Stearns, and then in September you had Lehman Brothers. But again, in the 2000 summer, if I recall, Bank Paribas was shutting down some of their mortgage products. So there was evidence. But that said, that Bernanke was at testimony saying everything is fine, you know. So so that this is an imperfect world. I guess my answer is they do their best to communicate. They don't want to shock the system, but you know, you can see the systems are shocked, and some of it arguably is outside their control. But I mean, fundamentally, you know, you can see I'm just showing from 16 to 20. There were very deliberate steps going up here to what they did was quantitative tightening, and so that was well signaled. And then of course we got this situation with COVID, which is completely out of control of central bankers. I mean, certainly they would have people that would have been following that and might have been preparing packages. Okay, so this is you know, a noisy chart with the amount of commercial paper amounts outstanding in trillions of dollars, and huge markets. What I draw from this in the most recent times on the far right of the screen, Perry, is that it doesn't appear to me yet that there's a credit crunch. Although David Rosenberg, in some of his writings, which he's trying to get me to pay thousands of dollars to subscribe, but you know, he's talking about particular indications, specific numbers on actual credit contraction. Now, the next slide I've got here is the annual growth rate of commercial bank credit. And from 2007 through to the current period. And what you can see is, of course, large increases at the time of COVID and so on. But there does appear to be a slowdown close to zero. So I wouldn't be surprised that the next line down is going to be below zero. So what the Fed and central banks always talk about is trying to engineer a soft landing, which means that we want to, as much as possible, through our interest rate tightening, not cause the economy to crash, but you know, to land smoothly, and there's adjustments through the system. People will eventually get wage increases so they can afford to pay higher rates of interest and so on. Okay, so this is the commercial real estate and residential real estate loans over time. So that would be quarterly data. And this is a corner of the financial system which there is a lot of attention now being paid to, because commercial real estate is a significant portion of banks' assets, and some of the regional banks in the United States are particularly significant commercial real estate lenders.
So in the US, they have regional banks. We have very few in Canada. We're really a national banking system. So there's
Yes.
quite a differentiation between the exposure in Canada, I hope, or I think, having national banks versus having these regional banks, which invest in their local and their regional development.
That's right. That's a very good point, Perry. So the regional banks on the real estate are bigger lenders than money center banks, the JP Morgans, as a percentage of assets. So this has become, again, part of the concern around, First Republican Bank. Not as big a concern with Silicon Valley. There were it was a mismatch of their assets and liabilities. But because of COVID, and as we discussed before the start of the program, the issue of work from home, we've seen in this country and other countries a lot of concern centered around the high vacancy rates. I mean, there's no problem with commercial real estate vis-a-vis renters. There's really a shortage of rental space, but with these big office towers in Calgary and Edmonton, Vancouver, and so on, you see 20 or 30% vacancy rates. And these tend to be not the new buildings where you have these, what they call AAA class buildings, but the B and C, the older buildings, and big companies will look to move up into a better, more modern building, that sort of thing. So this is something that's going to be watched, I think.
Yeah. Would you agree that the Canadian banks are really, I won't say immune, but less exposed?
I can't imagine it would be anywhere near that $180 billion.
Okay.
What
about the smaller banks in Canada? I mean, the ATBs, the CWBs, the banks that are clearly into the economic development of those regions. Alberta seems to be weathering the economy well, given the continuing demand for our assets. But there must be smaller banks in Canada that are somewhat more exposed to the commercial and the residential real estate market tensions.
Well, in the case of ATB, the last time I looked, they had about $5 billion in commercial loans. So that was an exposure of say 80. Well, it's exposure over their capital base, their retained earnings. So, and I hazard to think that a lot of that would be in Calgary. So it has a deposit guarantee 100% by the provincial government.
Right.
I do sometimes worry a little bit about that. They also have $3 billion to the energy industry. Most of them, I think, are junior companies that have been struggling. Mm-hmm. So they've dodged a bullet with $80 oil prices for now. Right. CWB is less exposed to Alberta. They're less exposed to energy. They've more or less gotten out of it, and the commercial real estate they know what they're doing, and so I don't think we have a problem there.
If we have an economy that is not sufficiently diversified, then banks are going to feel that pressure as well. So until such time as the Alberta economy becomes more diversified, that is today heavily reliant still on oil and gas and agriculture for that matter, that puts the banks in a little bit more of a delicate position than if you've got a more diversified economy. Would you agree?
Yes, and certainly in the 80s when prices went from $40 down to $7, I think it was well known that if the banks were segmented by province, that the Royal Bank of Canada, Alberta would have been insolvent. Mm-hmm. But because of the national system, right, there's certainly been a lot of notoriety in the last week or two about the Royal Bank as well on their being the world's biggest fossil fuel lender. And that would be concern to me as a shareholder over a period of time in terms of how they're going to extract themselves from that. A little glib here, the effects on the global economy, not just North America. I mean, who knows? And as I talk to you, are we going to come into a recession? Is it going to be a soft or a hard landing? We know that the employment has held up very, very strongly. And I think part of that is just the demographics of aging populations in North America and elsewhere. Businesses do need people. As we touched on, is the question, the kind of the immediate question, will the Fed put a pause on interest rates? And I'm not sure what the betting is today as to whether the betting is they'll put it up 0.25% because they're still concerned about core inflation, or whether they'll signal to the market we're going to pause and see what happens to rates of inflation, employment, and so on. That's the term they use, is waiting on more data. And then, as we discussed in the previous slide, the commercial property and homeowners. So when you see debt service ratios start to go up, and a point across the whole economy on a 0 to 100% scale, it doesn't look like much, but relative to where it's been, it's significant. And that's, I think, why we are worried about some of our children and family members that may be a little bit more leveraged than we are, and how they're going to deal with that.
Bob, this note on are we going to have a recession? We've been talking for almost 2 years now about soft or hard landing. This seems to be a rather gradual process of trying to figure out when it will arrive. It's like the boiling of the frog. When do we ever know whether we're in a recession or not? Yogi,
well,
I'll call on you.
Yeah, I think that the indicators that are most often used are 2 quarters of negative GDP growth or falling GDP. You don't know that until after the fact. You see rising unemployment. You see more stores empty, more closures, more business bankruptcies. We haven't seen much of that at all. David, Rosenberg, bless him, he is a perennial bear, and he sees that all the data, historic data, is 100% we're going to have a recession. And he's been saying that for some time.
Right.
And as you say, for the last several years, there's been that worry about a recession, and worry about the fact interest rates have gone up finally because the central bank are worried about interest rates. So that's why I put who knows. I don't know.
Okay. You have a question here?
Yeah. I mean, I'm not a real expert, and it's like the price of oil. Who knows, right?
Okay, Yogi.
I'd like to build on your comment about we've been worried about a recession for 2 years, and everything that I see suggests we are experiencing a soft landing, i.e. employment is strong, GDP growth is modest, and that the sharp rise in interest rates relative to where we've been for several years have achieved their effect on slowing growth. Is that too optimistic? What do you think, Bob?
Well, I think that that there's certainly a lot of data that would support your point, Yogi. And you know, this Macklin seems to be quite content to put it on pause and wait and see. Employment is still strong. I think the concern from a financial markets point of view is going to be bank credit and the unsettlement that the Silicon Valley Bank caused. And when banks feel a bit under pressure from depositors, so that they will begin to start pulling back loans, calling loans, because most commercial loans are in theory callable. Now you don't call a loan on a $60 million credit, but you negotiate it and signal it down and bring some of that down. And sometimes you just make very brutal decisions that we don't think this business is going to make it, and we restrict credit. So that is, I suppose, part of what Rosenberg is concerned with. And we've seen layoffs in the tech area. What was it, Meta today announcing more layoffs? So, you know, it's interesting. The heart of the growth in the American economy, or what's said to be the heart of the growth, Silicon Valley and San Francisco, is kind of the center point of kind of a bit of an earthquake. And so who knows?
So, I mean, what goes on in the economy of California may not be particularly relevant, or may be relevant worldwide, but may not have as much impact as, say, construction. When you look at the real estate market, and if housing starts to slow down, the number of people that will be thrown out of work, that are in that lower middle class, if you will, or the blue collar workers, that could be an extremely significant impact on your, quote, soft landing.
Yes, in the Canadian economy, I mean, there's a lot of concern about we're just not building enough, and partly due to immigration. In the U.S. economy, I really
more diversified.
No, I mean the contribution of housing construction from, say, 2002 to 2006 on GDP growth in the U.S. was enormous, and it was similar in Canada. I'm not sure that we definitely have not had that kind of boom in the United States. We've had existing housing prices kind of go up and up and up, but we've also seen in the U.S. less willingness to borrow money. In Canada, we've had this situation where more and more debt has been piled on, which is a worry to both the government, because they guarantee a lot of the mortgages through CMHC, and it should be a worry of banks' chief credit officers.
There seems to be a fair amount of volatility, even though we may be in this soft landing. I mean, we had the Ukraine, we've had the Silicon Valley Bank, we had COVID a while back. We seem to be in an environment where volatility seems to be the name of the game, and getting back to some form of normalcy. I don't know whether that will occur, but when I walk through the aisles of the supermarket and I hit the meat section, I mean, that's my entertainment for the day.
Well, you know,
I'm glad you're easily entertained, Perry.
Look, I saw a couple of porterhouse steaks, if you can even see them anymore, that were equal in price to what I bought my first Volkswagen for.
You're dating yourself, Perry.
I know.
What I didn't mention, of course, was Credit Suisse as well, which is
right.
kind of in a way came out of the blue, and talks about their general managerial incompetence and lack of good governance, and the forbearance by the regulators to see a bank which had assets, I think, of about 800 billion US with a market cap of like 7 or 8 billion. It just, that's the worth the market says on that. Now come back to volatility, Perry, for a minute. You're quite right. Rosenberg has commented on this quite a bit in his writings, that over the last year or so, the number of 400 points up and down on the Dow Jones is just outstanding, unbelievable, historically high. So equity markets are a little bit on a razor's edge, and part of that is related to, well, we've had this free money, the punch bowl, for so long. Now, we have to actually work for our money rather than just, leveraging on thin air. So that is once again a concern of the Fed. I think it's misplaced, and it's the famous Greenspan and Bernanke and Jerome Powell put, which is if the equity markets go down 10% overnight or very quickly, well, we'll just drop interest rates. So that's something that they're watching as well.
So also watching wage demands. We've seen that for a long while the wages seem to be pretty stable, implying that that individual income was not keeping up with the cost of inflation. And now we've seen some wage increases, particularly in the low wage sector. And now we have 155,000 public servants, deputy ministers getting almost $300,000 a year. They seem to be nicely cushioned. I can recall years ago, we wanted to make sure that the public sector did not lead wage increases. Well, that seems to be completely flipped now.
Well, I push back a little bit on your comments about provincial or federal deputy ministers. I would think that and this is not a fair comparison to compare them with CEOs, but I mean, we've seen an obscene increase in inequality and in salaries of CEOs, that 200 or 300 times what the average worker gets. And I think you, as a former deputy, Perry, understand the long hours that federal and provincial deputies are used to, and the enormous complexity in running their departments compared with selling groceries. Now, that's glib. It's a complicated business, but now there's always you always get into politics and different views on should the public sector lead, and I think my view would be no. My view would be that if the cost of living is going up substantially, and you haven't got a raise for a period of time, or it's been so modest, then I think the government, it is wise for them to find a way to accommodate that, because you are managing services that impact everyone in this country. So again, it's not an easy balance, and but I mean, I think in this province, I mean, the teachers were just crazy to accept basically nothing, given that their signals were all over that inflation was coming in, and it was a close vote. But anyway, let me just finish the presentation. We can open it up. I think in the Silicon Valley Bank issue and Credit Suisse and others, I mean, there are the social media effects, and that the rapidity of the run on the Silicon Valley Bank is a product of both social media, but also the technology and the ability to go on to your online banking and withdrawing everything in your account, for example. And if you're a corporate treasurer, you may not even have to call up the treasurer people in the bank and say, I'm taking out 100 billion or 100 million. Too much liquidity. Again, this is the Bernanke solution to the global financial crisis, which was to bail out the banking system through quantitative easing and inordinately low interest rates, leading to more risk in the system. And you know, we're back repeating that after COVID. We're seeing this, and we're seeing the effects of both COVID and just the liquidity washing through the system, driving up housing prices, which do come into play in the CPI, and driving up a whole range of other things, plus the Ukraine situation. And I'm still agnostic on whether this inflation will burn itself out in the next 3 or 4 quarters, or whether it's somehow endemic to the system, endemic. And then the last one is, you know, it seems to me that supervisors in Switzerland and the US were caught off guard, and surely they would be monitoring the impact of what tightening monetary conditions are going to have on financial institutions. And the fact that Silicon Valley had these huge market losses, I mean, secure government of treasury paper, but that it had to go to market to get funding through share issues. And immediately the underwriters are going to say, well, what's the problem here? And perhaps some of the underwriters leaked it out that there's this massive liability or deposit loan mismatch. And that's what started it. And somebody phoned somebody who phoned somebody. So one final comment on the solution by the Fed and the FDIC. I think that bailing out everyone is not the right solution. But in the minds of the people that had to make the decision, they made the decision. But it creates a lot of moral hazard in the situation in the system. It bails out multimillionaires who don't need that, and I think it's mistaken kind of policy. But I'll leave you with that and look forward to questions.
Your comment on the supervision is really germane when it comes to election time and when it comes to professing that the banking system is independent, that the economy will take care of itself, that government doesn't need to get involved, that the banks can do and get fixed on their own. That Credit Suisse problem was known for a long while, and yet it wasn't until the crisis happened that finally it got dealt with. Yogi, you've got a question here? Unmute.
Yeah, you know, this whole inflation issue and how we see Congress putting the pressure on Powell to reduce inflation. And I'm sure Powell would like to say, you idiots here in Congress, you're the cause of a big hunk of this inflation. If you would get your act together, it would make my life a lot easier and you wouldn't be trying to beat up on me. I'm trying to be a little bit dramatic, but do you see it that way or do you see it differently, Bob?
Bob, get your screen. You can take that question slide down.
Okay, so I'm going to stop the share.
Yeah.
That's better.
Yeah.
Well, there's no doubt, and given my interest in public finance and government borrowing, I do think that the reign of the U.S. dollar will be coming. I think before I pass this life, because it's just too cavalier, that the views of markets about the U.S. dollar and it being this sacred trust with politicians, as you say, Yogi, in Congress, talking about balancing budgets, but a dysfunctional political system that will go to the wall over defaulting. So we've got that problem, which is a huge problem for the central bank. A central bank that is prepared to add trillions of dollars to its balance sheet, a lot of it in the quantitative easing junk securities. So if you want to have faith in a central bank, you have to have the faith in the balance sheet, and the balance sheet is the balance sheet of the United States. And I mean, these deficits keep going and going. The U.S. economy is essentially exports food and exports weapons and imports everything else, and I mean some planes too. But so I just don't think it's going to continue merrily along.
So two points there. I mean, one, the U.S., like China, is a consumer economy.
Yeah.
Point two, so it relies on imports, cheap imports, in order to sustain happy consumers. I think that's just an observation, but the point I want to come back to is the volatility and the shocks. I think we all know that there are so many symptoms of the U.S. financial system being in a mess.
Right.
And being confused with all the politics that seem to be involved in the U.S. economy. We've politicized everything else. We've politicized its economy. Its debt is significant. But we've seen over and over again that change doesn't happen until there's a shock. What is that shock going to be? Is it going to be something like defaulting?
Well, as I say, I mean, the Congress is dysfunctional, and I mean, I think they've settled the debt thing for a period of time, but
Again,
it keeps coming back because partisan politics wants to achieve certain specific goals, which tend to be narrow and parochial.
Okay, so
sorry.
The one shock that I'm wondering about, Perry, is the Chinese are pushing hard to make their currency, the yuan, a reserve currency, and they're not getting a lot of traction at the moment.
right.
But their persistence, plus the continued growth of their economy and their dominance in world trade, and if we continue to have this crazy deficit spending in the US, maybe that shock that makes a change as the Chinese get some traction.
Well, could the shock be that some politician finally steps up and says enough is enough and carries enough votes to say we need to literally overhaul our debt and figure out how we, I mean, I don't like the word default, but it wouldn't be the first time in history that a country finally acknowledges the fact that, and particularly with an aging population, that's going to take a lot of wealth either out of the system or they're going to tax the hell out of it to address the debt. You might want to comment on that, Bob.
Well, an aging population is a real concern. I think in the United States, like Canada, we still and we will continue to rely on immigration. We're still seen as a shining city on the hill. So that will help grow the economy. But I was talking to someone the other day about this whole demographics issue, and and it's particularly acute for China, for Japan, and others, Italy, and so on. And that how does an economy grow when your population is declining? And that, I mean, capitalism, I mean, even China's capitalistic, depends on that unrelenting growth. But to come back to the historical set of transitions that we've gone from, you know, the Pax Britannia to the Pax Americana, and you know, the British period of ascendancy ended at the First World War, and Wall Street kind of financed the war for them. Could we see a similar scenario where the Americans take on China, for example? Where are they going to get the finances from? Or they take on Russia and China decides to finance it. I don't know, but we certainly are seeing the decline of the American empire, and I think so much of the empire's strength was based on the U.S. dollar that you know, literally in the Iraqi war, I think they brought billions of dollars of banknotes and kind of spread them around. So other countries don't have that liberty to do that. I don't think that's going to last much longer. And so that could be a scenario where you see the dominance in the economic and financial system moving somewhere else. But
my only comment there, Bob, is you know, I've been in Canada now 50 years, and a year hasn't gone by where we haven't talked about the American decline.
yeah, no.
Maybe I don't know. Maybe it's wishful thinking. I don't know.
I think the American decline is premature, particularly when what Bob referenced earlier about the demographic issues in China and Japan. That may well scuttle the China's ambitions to launch a reserve currency.
Yeah, I think, I mean, you make a very good point. I think Macron has seen what the politics are of trying to address the aging issues. I mean, it's going to be heavily political. My comment earlier, Bob, and I've asked a number of others, and I don't seem to be getting the response I'm seeking, so I just keep on asking till they finally relent. But it seems to me when $1 trillion is going to be moved in the economy as an aging population finally moves out and dies, and $1 trillion is passed on either to the next generation, which is inflationary, or government sees it coming and says, well, there's a way to pay off the debt. That debt that we have was accumulated during the baby boom rise. We'll take the wealth off the baby boomers as they pass out of the system and pay off that debt. That would be very popular among some hoarders.
Well, I mean, certainly that's
a wealth transfer.
Yeah, and I mean, wealth. This whole debate about corporations not paying their fair share and so on, and Thomas Piketty in his book Capital in the 21st Century, I mean, looked at the evolution of capital from land to industry to now intellectual property, and we know how capital is very adept at shielding itself from taxation, and there is, I think, growing inequality. Some governments are at least acknowledging it. Most governments aren't going to do anything. But that could be a vehicle of saying that special treatment for dividends or capital gains, and there's been discussion in this country about that, should be treated the same as any other income. So there is a thing. There's a lot of money on the table, you're right, Perry, that could be taken by governments. But again, the problem is you've got people like Murray Edwards, who decamps to London and now he's in Switzerland. Gates and company are just putting it in the foundation so they can kind of control where the policy areas or issues that they think are important for the world. It's very difficult. I know Al O'Brien, the former deputy in Treasury, we talk about this issue, and Al said it's very hard. How do you trap that mobile income?
Yeah.
Because
okay, well, let's shift gears at least once more. We've got a little bit of time. Alternative sources of financing, cryptocurrency. How relevant is the emergence of these new forms of asset?
Yeah, well, I think part of it is a response to the notion that governments can't be trusted to inflate their way out of debt or other things, and that has been the marketing story to crypto investors. My belief is that this is just like another tulip mania, and there's nothing there. Blockchain underlying it, I mean, makes some sense as far as I can understand it, vis-a-vis using it for land titles and finalizing legal documents and things like that. But in terms of a currency, no, I think it's very dangerous.
So the game is a trust game. I mean, so you've got trust in the American dollar. As long as you got trust in cryptocurrency has a market. If people are prepared to buy and sell and trade and believe it has value, it has value.
Exactly, but I mean, there's the store of value argument, and then there's the exchange value argument. And the difficulty with Bitcoin and these other things, despite the efforts to, make it easily accessible, is that it's not a very good vehicle of transferring value. And
somebody disagrees. I've seen the price of gold now exceeding $2,000 an ounce, and I've seen an almost equal 23% increase in Bitcoin. People are moving money. That is an indication of trust. It isn't going in the other direction. It's volatile the same way interest rates appear to be volatile.
Well, Perry, I mean, you could say that it's a measure of trust. Mm-hmm. You could also say that it is an object of financial speculation. Mm-hmm. And that's what really ultimately the tulip and the, the Mississippi Company and so on are objects of speculation. So I would just caution people that, don't invest in things you don't understand. I can remember
that's Warren Buffett.
But ABCP, Larry Pollock's bank didn't have any ATB, had over $1 billion. Larry said, they came to sell it to us. We didn't understand it, so we didn't buy it. Right. So that's, my investment advice to the group.
Since we've been discussing OpenAI and generative AI so intensely since November, do you want to comment at all about what the ramifications may well be or may already be of this new form of knowledge management and what it might mean in the financial industry?
Well, I think it has enormous implications for the financial industry. And I would think the geniuses at Goldman Sachs and JP Morgan and RBC, they are using AI in their investment strategies in one way or another. I mean, as I understand it, it would be a way to collate and analyze and see patterns in the data that other like humans couldn't deal with. I mean, I'm in my little business, I'm trying to use chatbot because the policy areas that I want to understand are so complex that I really need a search engine that can do a lot of the basic, bringing the information into spreadsheets, so I can begin to see the patterns in it. And it's a very, very powerful tool, and I think it has a lot of opportunity, but as we've seen, it's getting politicized like everything else, right?
Well, I think you're talking to a group of the converted. I think we've spent some time watching the hype, certainly looking at the negatives and recognizing that there's politics. But I think our general conclusion is this isn't going away. It's going to get better and better, that the suppliers are not purely interested in capital. There is an interest in fixing this so that it works well and increases the number of viewers. It's there. And I think, as the Law Society has said in Canada, watch it or else. It's going to happen.
So to me, when the control of the economy, that graph with the interest rate bangs up and down, as an electronics engineer, it tells me that the control system is wrongly designed. It reacts late, and as such, it's going to create further oscillations because it's going to overreact. It's going to go to the maximum it can put in the market, and so on. So that's one concern. The other concern, and again, this is an electronics engineer talking. We've printed money and we've inserted money into the economy. As such, I would have called it differently than inflation. To me, the word inflation was linked to an economy that it's overactive or so. The moment you print money and you dump it, it's not the economy. It's the decision to print that it's under discussion. And I'm gonna stop.
Two good points. I mean, we have raised the issue of volatility, and maybe we need another international convention to bring all parties together, as they did, I think it was at Woods Hole after World War II, and said, we've got a mess, too much volatility, what are we going to do about it? And whether or not whether or not the East and West could meet over this, whether there's any middleman in this world anymore, I don't know. But you might want to comment further on volatility. But the second point that Bogdan makes is a good one as well. Bob, you want to comment there?
No, I don't think so. I think of the volatility in some way as looking at people's blood pressure, heartbeat, and the event there's a crisis and you see things going up.
Well, I mean, what's interesting is economics is in the arts department. It's not in the science department.
Well, if you talk to some economists, they think they should be in the mathematics department.
To me, you print money and then you raise the interest rates, you're gonna double hit the economic side of the equation. Yeah, you're just moving load from a social benefit to an economic challenge, so to speak.
What you've just raised, Bogdan, is almost a summary of what I think we've talked about today, to Bob, and that there's a lot of psychology to economics. When you leave interest rates at 1%, you're changing human behavior as to what has value and whether or not they feel that that value will in fact be sustained. And what we have is entrenched. We never thought that interest rate, in fact, it seemed to be continuing to go in the other direction, that if the economy wasn't responding, we were dropping interest rates below zero. Well, all of a sudden we're feeling the implications, and human behavior has to start to change. We've been shocked. Whether or not people will continue to buy as they were, to vacation as they were, to live the lifestyles on borrowed money, and borrowed money is essentially 1%, or whether we live on the borrowed money of the federal government and a nation living on public wealth, which is based on the debt of the future. I mean, all of these things seem to be we've lived for a generation now on the welfare state, that somehow all we have to do is print more money and all will be well and we'll be comforted and we'll have big houses, maybe bigger houses. I don't know. It just seems to me at some point in time, this has been fairyland. And now we want to fix the climate with more debt. I don't know, Bob, you've got the last word, so I'm going to tell you to unmute and challenge my summary or give us your own.
Well, I think that there is no free lunch, but the economics profession and Keynesianism in particular led people to believe that government borrowing was benign and it wouldn't have any consequences. But I think in the 1990s we saw there was significant consequences with the cutbacks, both at the provincial and federal levels. Capital markets do matter. Faith and trust in both currencies and central banks and governments do matter. Governments tend to react to events, some of which they can't predict, such as COVID, such as Ukrainian crisis. So we do have to pay our own way. And I think when I reflect about Alberta, when you go to the grocery store or any stores and you buy things, most of the stuff is not made in Alberta. But what our lifestyle has been based on has been digging out, pumping oil and digging out bitumen. And right now we're sort of living high on the hog. We're getting 150 billion a year or something for it. But next year it could be 70 billion. The way that I guess global capitalism has unfolded has been that you've had extractive industries in the periphery digging up commodities, and commodities set in financial markets, and speculators that have their own agendas, and that for a country like Canada, which is in the hinterland, and a province like Alberta, it is a very difficult, challenging subject to transform collectively into a system which is more self-sustaining. And I think global capitalism is at a crisis, because it has the nationalistic issues, but it also has the environmental issues, and it has the whole question about the fairness of the distribution from this very powerful economic system.
No one that I know of in economics believes that the free market alone is adequate, that you need a regulatory force.
Right.
So the situation we've gotten into, if one wants to point to anybody, you point to government has been lax in its regulatory roles. Now, someone in our group has talked about, well, we've got to compete. So we'll cast a blind eye to the environment because we have to compete. But someplace at some point, the politician says, hey, wait a minute. We've got health matters. We've got job matters. Sustainability means we can't continue to cast a blind eye. At some point in time, somebody says we have a crisis, and you've alluded to it.
Yeah.
That says to government, if you can't do it, the market's going to do it to you. The climate will fall apart, the electorate will get frustrated, or a whole new political system will evolve. So if we're on the edge of something, I guess we're all going to watch. Maybe ChatGPT has an answer for us. We'll have to check tonight. Thank you, Bob.